Hello guys, this is Renkat on Renkastar FX. Today I will be talking about the three pillars of risks and money management in the forex market. And there are three pillars of risks and money management in the forex market. If you're able to handle them properly, then you've done the major part of risks and money management in the forex industry. So the three pillars consist of 1. The account size, 2. The leverage or the margin used, 3. The position size or lot size. Most brokers offer 2 to 3% leverage. So your account size determines the cash value of 2 to 3% maximum loss you can afford, which means it determines how far you can set your stop loss orders from your entry point. So the larger the account size, the wider the stop loss you can afford, and the more choices of trades you can have available to take according to your chart analysis. So how do you manage risks from your account size? So to manage risks from your account size, it is advisable to use a daily drawdown. A daily drawdown is the maximum amount of money you can afford to lose per day, which is in percent. For instance, let's say your daily drawdown, the DDD, is 10%, and the amount you are willing to lose per trade is 2%. So you will have to discipline yourself to open only 5 trades per day. Now when your trades unfortunately end up in red with 2% losses using stops and lot size that can take only 2% per trade, you may end up losing only 10% of your capital. So let's say in a $10,000 account size, your DDD is only 1,000. So you can only lose $1,000 per day and still have remaining $9,000 in your equity, which means you only lose a little portion of your capital per day. You still have multiple chances of making it right the following days, other than losing 50 or the whole of your capital in one day, and you just remain on bench watching the game going on. And 2% loss per trade will be $200. But in a $1,000 account size, your DDD is $100, and your 2% loss per trade will be only $20. So you can even make your daily drawdown lesser than 10%. And you can also increase the account size, meaning you can use 5% daily drawdown for a 3,000 account size instead of 1,000 account size that I illustrate here in this example. So for a given account size, the maximum loss you can safely afford is the function of the leverage or margin use and the position size or the lot size, which are the remaining 2 of the 3 pillars of risks and money management. And the second pillars of risks and money management is leverage or margin use. And this fixes the percent loss you incur for each 2 to 3% price move against you per lot traded. So the greater the leverage or the lower the margin, the greater the percent loss for each 2 to 3% price move against you. And the lower the leverage or the higher the margin, and the smaller the percent price moves against you without exceeding that 2 to 3%. That means the higher the leverage, the higher the risks and the profit potential per trade. Some brokers allows you to adjust the leverage to your taste, but some don't. So it is advisable that you reduce the leverage in order to minimize the risks and trade safe in the forex market. Now the third pillar of risks and money management is the position size or the lot size. It determines cash value of each pip or 2 to 3%. For a given leverage setting, the larger the lot size used, the more every pip moves against you. That means the larger the lot size, the higher the risks and the potential profits. So it is advisable that you categorize the risks. For example, using an account size of $1,000, Now the lot size under the level 1 is going to be 0.2, while under level 2 is going to be 0.6. Level 3 will be 1 lot, and level 4 will be 2 lots. While under account size of $10,000, the lot size under level 1 will be 2 lot size, and level 2 will be 6 lot size, and level 3 will be 10 lot size, while level 4 will be 20 lot size. So under the account size of 1,000, 2 trades is expected, while under account size of 10,000, 3 trades is expected to open, with the exception of gold instrument. And this illustration is for scalping techniques. While for the intraday techniques, under level 1, for account size of $1,000, the lot size will be 0.1, and under level 2, the lot size will be 0.2. Under level 3, the lot size will be 0.6. Then under level 4, it will be 1 lot. While same under intraday, and the account size of $10,000, the level 1 lot size will be 0.1. The level 2 lot size will be 0.3. The level 2 lot size will be 3 lots. The level 3 lot size will be 6 lot size. And the level 4 lot size will be 10 lot size. So on gold market, you have to reduce the lot size by half, because gold is very, very volatile in the forex market. Another way to reduce risks under position size is through layering, where you will be adding lot size gradually as price goes against you with 10 to 15 pips, and keep it consistent, and still maintain 2% per trade and 10% daily day drawn. So this different risk level idea is just for you to choose which one that suits you. To me, I recommend the level 1, because looking at the stops I give in the scalping techniques, which is 30 pips, and the intraday techniques, which is 60 pips. Now considering their lot size respectively, you understand that the 2% per trade and the 10% daily day drawn still maintain. But if you still think you are very much aggressive in trading, you can increase it to level 2, and gradually as you are making more profits in the market, you can still increase it to maybe level 3 or even level 4, but not to start with level 2 or 3. And it is advisable that you open different accounts for a different risk level, in case if you want to trade across the different levels, and diversify your risks in the market, because they have high chances of substantial risks as well as high potential profits. This is Renkat on Renkastar FX. Bye.